good morning, good afternoon, good evening, whenever you are watching this week's video. Y'all, we a day late, but not a dollar short. I just always wanted to say that. That don't mean anything. For those who are just now watching this and y'all like, who is this lady and why did she say that? That was corny as heck. My name is Patrice Elberry, EA, registered trademark, um, aka the tax cop, registered trademark. It's registered trademarks everywhere. I am so blessed. Another one of our trademarks has gone through and is officially registered. God is beyond good. Um, we are in the land of the living. I'm sitting here and being like, never in a million years when we started this did I even think this. I am so grateful for the opportunity to be able to be building brands upon brands, assets, legacy building for my children. And I pray one day they look back on it and say, Mom, we know you worked hard and didn't let us do certain things, but we are so glad that you started putting these foundations in place. Needless to say, we are talking about passive income this week. We're going to be talking about passive income for a while. And the reason why we're talking about passive income, because it's important to discuss, but I'm going to break it down in sections. Reason why is because I told y'all last week, I'm obsessed with trying to figure out how to build a straight dividend portfolio. Why? Because dividends are truly passive income. You are investing in assets, normally they're capital assets, stock, etc., that are kicking you off dividends of some sort and allowing you to have some income. Dope as heck, right? Now, you got to have a whole bunch of stock in most cases to get to this, like these large amounts. But one of the dope things about investing in assets that kick off dividends is that if you reinvest the dividend, eventually the dividend gets to the point where it is buying more stock. I remember listening to, I believe it was Wall Street Trapper. I was listening to Wall Street Trapper and he was talking about Jamie Dimon of Capital One. No, JP Morgan. Duh. In my head, I got to do something with Capital One. JP Morgan. And in the discussion, this is what really intrigued me. He was like, part of his compensation package was the fact that he getting shares and he's been reinvesting the shares. And so when you look at, he's been reinvesting his dividend, right? So when you look at just how much that is and then he cashes in and stuff like that, that type of stuff, I'm like, man, some of you all are in companies that y'all work with that you get RSUs and then you cash out the stocks as compensation and then you leverage that, and et cetera, et cetera. And some of y'all are working for companies that give you RSUs that actually also have dividends. They're dividend companies. And so they're companies that pay out dividends. So I think that's really dope as heck that could even be some of y'all compensation package. I also remember on 1 week of Trapping Tuesday when they were talking about Nvidia and how now, and I know right now when it's being recorded, like the shit, Nvidia on sale, okay? But Nvidia, and the people that work there are like rich millionaires, and you know what I'm saying, billionaires, like because part of their compensation is in stock and the value of the company and what it was, and so just the concept of that. And them being able to get dividends and reinvest and buy more shares from the dividends, just what a interesting way to look at compensation. An interesting way to look at building wealth. And what an interesting, now they are actively working for the company and getting this stuff, but at the same time they are getting hard-earned salaries. They also are making passive income at the same time. And so for me, that intrigues me. And of course, we're talking about what's recognized versus realized. And I know y'all are like, that'll be another week when we talk about stock and capital gains and all this kind of stuff. But right now, I want to talk about dividends from a tax stance. I'm not going to talk about it from an investor stance any longer. I'm intrigued, y'all. I've been studying. I'm studying and I'm still studying to figure out, okay, what do I do? How do I build a portfolio specifically just for dividends? How do I start to teach my kids that at their ages, because they're much younger than I am? Just things to think about. And I've seen clients be able to get a certain amount of dividends in a year. And I'm like, yo, this is, and I tell them this is dope as heck to me, right? Because now I conceptually like, oh, I'm looking at it outside of just building wealth, but I'm also looking at it from the tax code. So what we're going to do today is we are going to break down how dividends are actually taxed, because we got to understand it. All right? All right. Y'all with me? Let's ride. Okay. So hopefully y'all can see the entire screen. It's qualified versus ordinary dividends. Did y'all even realize that there were two different types of dividends? You probably do. If you have dividend income, you already know this. You probably like, yep, and what's the difference between the two? I see them on a tax return, right? And I always be like, one be in the box to the left and one be in the box to the right, and that's the taxable one. And the reason why I may even record it that way and explain it, but there's a whole worksheet and calculation that happens behind it, behind the scenes, to explain what gets done. The reason why is because qualified dividends, which is on the left side of the tax return, that box to the left, it'll be what, box 1B versus 1A. And 1A is the one that's like in the line going down, taking income. Y'all probably are like, why does she, y'all can't even see me, thank God, because I'm making body rolls and doing all kinds of stuff in here. So qualified dividends are taxed at capital gains rates. 0%, 15%, 20%. And I've mentioned this before, and we'll go through this when we talk capital gains tax, but most people are actually right here in this range, in this 15% range, when it comes to, can y'all see, most people are in the 15% range. Based off of where their income is, we got a lot of people who have capital gains that get taxed at 0%, but there's quite a bit of people that 15% of that is being taxed. Well, how does that work? How do I qualify to get qualified dividends? I'm glad you asked. Your stock has to be held for 60 days plus days in a 121-day window. And if I remember, is it 240 days? Something like 240 days in a trading year, and half of a year would be that 121. So at least for 6 months, 60 days within a 6-month period, something like that. And I'm doing it based off of trading activity days, not full calendar days. Okay, so at least for 2 months in that time period, you gotta at least have held the stock for that long. So we talking about, in reality, we should be talking about holding this stuff long term. Why? Because it kicks us off income. Now, yes, the income is taxable, but eventually you're going to get to the point where you may come off of a W-2. You might have a business, so you get 1099 NEC income, or you might have a retirement that you get, a 1099-R. So just something to think about. Where is this reported? It's reported on Form 1099 Div Box B. And I said, if you actually look on those lines, I look at it in my mind, I'd be like, it's on the left side, not on the right side. This is how I talk to myself when I'm in here doing stuff. How examples of this are dividends from U.S. corporations or qualifying foreign stock. That's what we get capital. That's what we get our dividends. And that's the stuff we want to reinvest, so it can buy more shares of stock. Pretty darn dope. All right. Now, ordinary dividends. Because I'm not gonna stop you. I'm not gonna stop y'all recording. Ordinary dividends are taxed at ordinary income tax rates. So this is the same rate the rest of your W-2 earnings are being taxed. The stuff that's happening on the right side of the tax return, that line going down from W-2 all the way down to taxable income, that's where you're gonna see them ordinary dividends money. Huh? Yes. So I think that, think about the columns that's on there. Is that taxable? If it's going to be taxed at ordinary rates, we're going to go all the way to the right on the form. That's how it's going to be. Y'all probably like, why is she making no noise like that? Because y'all can't see me in here moving around. All right, ordinary income tax rates. There's no specific holding requirement. Interesting. You could have had it. You could, and this is why I think it's interesting. This is why. Because you can be like, oh, who give dividends? Coca-Cola, right? So, and I don't know their dividend yield. I'm just throwing this out here. Let's say Coca-Cola give out dividends, and you like, you know what? I need some income because stuff is crazy right now. And I don't know what's happening, and I got a little bit of coins, and it's earnings season, and they get ready. I'm looking at their history, and I want a little bit of extra money. So I'm going to get in 2 or 3 days before earnings when they're issuing out or before they're issuing out a dividend. Right? So that's gonna be an ordinary dividend. Y'all probably like why she paused like that. But that's the difference between the two. So there's holding period matters. Holding period matters from a tax stance when it comes to dividends and how they're taxed. So this is something to keep in mind. They're going to be recorded on Form 1099 Div. That's the left side one, box 8, 1A. Now, what are some of these things that go in here? Money market funds, REITs. And I do have some of these in my portfolio. So no matter what it's going to be. Why? Because it's like ordinary monies. REITs are real estate investment trusts. So instead of owning a property, you want to put your money in an ETF that does that property holding stuff. I like, for instance, one of the REITs that's in my portfolio is Prologis because they have Amazon warehouses. They're not doing that great. You would think they would be, but I'm holding on, and I only have it in my portfolio, in my just mixed up mash earn and learn portfolio because they kick off a dividend. That is truly why. And like I said, I'm in here trying to learn, and I was like, oh, let me do a separate dividend. I get a dividend. I get a monthly dividend off of a REIT. It's like when you own rental property and they doing a difference and they gonna kick you off your portion. The property management company gonna take their fee. They gonna kick you off your stuff so you can pay the mortgage, and then whatever you got left is gonna be income to you. Yeah. That's in my head. That's what we was doing because I'm like Amazon. Yeah, but when you look at how they in my portfolio, they red. But my dividend growing. I will say that my dividend is growing. Yes, ma'am. But it is taxed at regular rates. That is 100% taxed at regular rates. And then we have money market funds. Think of your money market funds, those dividends that you were getting, Navy Fed. Y'all see that as a dividend. It gets reported as interest, but think of that. Like if you had shares of something like that, because they call them dividends on a Navy Fed statement. It's taxed as interest, but in these cases, that's what's going on. That dividend, that's what's going on with that. All right. So we're gonna take a little bit of time and break this down more into examples. I'll give you an example of more detail. Okay, these are some dividend companies. These are some things to consider. This is what it would look like if this ended up on your portfolio. This is how it ends up on your tax return. We'll talk about that next week and break that down to that realm. But this is like just high level breaking down the tax rules because I want you to understand that there are rules and that stuff can be taxed differently. And the calculation isn't always a straightforward calculation. That's why there's worksheets happening in the background on these tax returns. I'm going to take you through a worksheet next week so we can see, oh, this is how they're calculating it. And then when you go look at your brokerage statement, you'll be able to go be like, oh, that's why on my 1099 div, I have something in box 1A and I got something in box 1B. And that's how come they end up on my tax return looking differently. All right. Let me know if this was helpful. Let me know if it gave you insight. Let me know what questions you had that you want me to break this down further so that I can actually gear this towards what it is that you are trying to hear in your ear when it comes to understanding passive income, what to do with it. Now, I will say this. I'm an accountant. I am an accountant that happens to invest. I am not a financial planner. I am not about to tell nobody how to set up their portfolio. I will tell you how that joint is being taxed. So I'm saying that as the tax cop, registered. Patrice L. Berry, EA, now registered. Anything I tell you is for education and entertainment purposes only. I cannot give you any financial advice. Please don't take it as such. I can give you tax advice, but that would have to be specific to your situation. So I am giving you educational information so you are aware to how to make moves in these investing and these tax trees. Don't say the tax cop said. Don't say Patrice L. Berry, EA said. She just gave y'all some tea. Until next week. Peace.